answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain. Thanks for joining us.
Yeah, glad you are here as we are participating in our radio program, podcast, talking about financial markets. Myself and my co-host here, we are both practicing financial advisors. We spend our money through Friday meeting with people like yourself, and we broadcast this program on the weekends to hopefully be your financial advisors on the air.
Or on your listening device. Whatever that may be.
Whatever air means anyway, right?
Yes.
For that matter. But I didn't quite understand how it all works.
It's all right.
Mystery.
We're kind of numbers guys, finance people.
Yeah. So obviously a lot to talk about this week. I don't think the markets are, go down anymore.
It's quite
I don't know.
interesting.
I saw this report that showed year-to-date 2021, the lower the priced stock, not like price-to-earnings ratio.
Just the price of the stock.
Price of the stock. The lower the price of the stock, the higher the return's been year-to-date. Like dramatically so.
Well, I think we talked about this a little bit. There's a whole new crop of investors that the Wall Street firms, or now they call fintech firms, financial technology firms, have gamified this investing for many. And
we're talking about stocks under $1 a share.
Yeah, they're gamified. It's all momentum investors.
100%. People don't even know
all
what
momentum. Yeah, they don't even have a clue what they're buying. You know, one of it was a Chinese, like a Tesla, Chinese Tesla. I think it was called OIN, O-I-N. And I was just looking at the stock. It was unbelievable. It was like Tesla. It's Tesla all over again.
It's funny. I had a call this week with an investment banker with Goldman Sachs. Goldman Sachs, obviously, well respected. And I was actually just talking about his work environment because he's Manhattan. And like, what's it like? And because Goldman Sachs tried to get people back in the office. So he was describing his group, and he's right near this group of traders. And I just said to him, I said, it's funny because when I talk to individual investors who think that they can do well by picking stocks, I said, always remember, I said to this guy, you're competing against a whole floor of traders who work for Goldman Sachs, the brightest kids out of the brightest business schools.
Out of Harvard, Princeton, Yale, Stanford, the whole bit.
The top business schools.
And they're trading in the company's accounts.
Correct. I said, that's who you're trading against. So
yes.
Anyway, if you look at some of these things, it's kind of crazy. And look, if you want to have a portion of your portfolio that you want to use for speculative gambling or whatever, and that's fun for you to do, fine. But have it be some percent of your portfolio. Keep it away from your serious money. Have it in a separate account from your serious money, and don't ever confuse the two.
Yes, understand what
this bull market will end. I mean, how much have we gained since the election time? Like 12%.
It's
like every day it goes up.
Yes. Which is, and we're actually seeing bond yields come up significantly as a percentage over what they were a few months ago, which means that it's going to drive even more money into equities, at least for the short term, as people take losses on parts of their bond portfolio. It's interesting. As I have said many, many times, I believe that what is driving this is a lack of opportunity and disposable income. People have more disposable income. I mean, the divide between wealth in the United States has gotten so much larger in the last year, and those that actually have jobs, their disposable income goes up. Why do you think people are actually remodeling or redoing their kitchen or their bathrooms? I was talking to a contractor. He goes, Pat, I've never been busier. Never been busier.
Oh, they're all slammed.
Yes, just nothing but busy.
Well, in part, you can't go anywhere.
You can't. Yeah, you have people come to your house.
Where are you gonna go?
Oh, I know. I'm driving my wife crazy. I'm like, let's just go somewhere. Let's go camping. Let's just do anything. She said it'll be over soon. I haven't been on a business trip in I don't know how long, and I can't believe I'm saying this. I miss the business trip every once in a while.
I know. I feel it's anyway. We're on this boat together.
Let's take some calls. If you'd like to join the show, it's 833-99-WORTH. If you have questions about your money, your 401k, taxes, IRA distributions, even life insurance, we will take those calls. Annuities, we have strong opinions about those. If you'd like to join the show, 833-99-WORTH. That's 833-999-6784. And we're going to go to the phones. We're going to talk with Sam. Sam, thanks for joining Allworth Money Matters.
Hello, yes. I have a question on 401k to Roth conversions. I understand that each conversion requires to be kept 5 years before you can withdraw without penalty or tax. How do you track earnings for each conversion when all the conversions are on one single account?
Let me ask another question. Why is this important to you? How old are you?
Well, I'm 65, so that wouldn't be a big issue for me. But the question just came through my mind. If I were below 59 and a half, how would I do that?
You would have to, you might have a record keeper where you've got your investments that could track that for you because they can track what your earnings are, and you can certainly track what your cost base. So if you converted $20,000 1 year, 3 years later you converted another account of $10,000, you know you have $30,000 in there. Any growth above that 30,000 is going to be growth.
Yes.
It's your cost basis.
Yeah, but I thought you had to track the earnings for each conversion as well.
No.
Buying and selling.
Oh, got it. In terms of the 5-year start date.
Right.
I don't know.
Why do you care? I mean, you asking a question. I mean, theoretically, yes, I suppose I've never done any financial planning with someone where this was of importance, and it doesn't sound like it is to you. So, what's the question?
Well, I misunderstood. You lost me here, Sam.
The 5 years. So you can't. In order to get your earnings out of a Roth IRA,
yes,
you've got to wait till at least 5 years or 59 and a half.
Yes.
So he's talking about you did one conversion years ago.
And then you did one a year later, and then a year later, and a year later.
And suddenly now you want to take a withdrawal.
I've never run into it.
Correct.
Yeah, I'd have to look up the answer.
So why do you care?
It was curiosity, I think.
Well, at first, when I first thought about this, I thought I would be impacted by it. But after doing more research, I realized that since I'm over 59 and a half, it doesn't impact me anymore.
That's right.
But you can always.
But the question is still in my mind: how can you track it?
Oh, well, you can track it. I mean, tracking it's the easy part, right? I mean that you could look at statements to see when monies were deposited in the Roth IRA, and that's the basis for that distribution.
And it's not such. Maybe
you're thinking about the growth on that.
But even still,
yeah.
All right, so let's say you converted $10,000 and you invested in
the S&P 500.
The S&P 500, and you took another 10. A year later, you took 10,000 and invested in Intel.
Yeah, and then I sold the S&P 500, and then with the gains, I bought something else.
Oh, they don't care what you own.
That's correct.
They don't care what you own.
They don't care what you own.
So what happens is you would actually look at the return and you would move it on a pro rata basis over that year.
You can and you could take out your entire earnings before you're into your cost basis on this. So you can go through and take out the earnings of it first.
Yeah.
I'm sorry.
But Scott, hold on a second. But calculating it would be pretty easy. It wouldn't be. It's simple arithmetic. What would happen is you'd look at the return for that particular year, and then you'd actually
record keep track of this anyway.
You'd weight it, but the reality is that a record keeper could just tell you what the number is. I know we could at Allworth if we managed money and you said, okay, I want to take this out.
Other than this hypothetical question that doesn't pertain to you, is there, of all things to worry about with your finances?
You know what the biggest thing that people should worry about, and they mess up the most on Roths is when they do a IRA conversion to a Roth conversion and they have non-deductible versus deductible IRAs. That's the biggest mistake we see in the use of a Roth. And by the way, if you're listening, thanks for the call, Sam. If you haven't done for the year 2020 a non-qualified IRA contribution and then converted to a Roth, I would suggest you look into that.
Yeah, kind of the back end Roth.
Yeah, and I actually just did mine. I'll tell you how.
You did?
Yes.
It's because you were married. Your wife did it. I bet you anything.
No, I actually initiated it, but I only
in January.
But I do it for 20 and 2021 all at the same time. And then the
Two
next
calendar years. I did this same exact thing.
And
but
then
it's
the
usually
next
in
time I'll
March.
do it in January of 23 is I'll do the same thing.
Essentially, what Pat's talking about here is if you cannot qualify to make a Roth contribution because you exceed income limits, you're still able, as long as you have some earned income, able to contribute to a non-deductible IRA. Now, we would typically not recommend use non-deductible IRAs, particularly with people who already have a bunch of other assets. But you can put the money into the non-deductible IRA, and then you immediately convert that to a Roth IRA.
And that sounds easy, except if you have other IRAs that were deductible IRAs, you have to convert it on a pro rata basis.
So you have to take those into account.
You have to take
As an
those
example,
into account.
I personally don't have, years ago I converted a small IRA that I had from when I was young to a Roth IRA, and I personally have no other IRAs. I have a 401k and a Roth. And so when I make a contribution to a non-deductible IRA, let's say I put $6,000 in it, and I immediately convert that to an IRA, my cost basis I already accounted for because it was a non-deductible IRA. It's not going to trigger any tax bill for me.
But had you had an IRA,
my wife has an IRA from when she worked at Intel, her first few years of being married, her 401k. It's interesting. You want to look at the benefits of long-term growth. She quit this job 25 years ago, and she had a very small 401k balance, which is quite a large IRA now, just letting the markets do their thing over a period of time. I don't try to time it. Don't try to say when the market get in or get. But if I were to do the same for her, what would happen is when I converted that to Roth IRA, it would trigger a big tax bill because they would look at pro rata that say, okay, you put in $6,000 into this non-deductible, but you've got
$100,000 in a deductible IRA, then you would actually look at it and you'd only be able to move 6% of the dollars in the.
Well, in other words, it would trigger a tax bill on it.
But listen, you should look into it. I do it every year, but the way I time it,
I do the same thing. I'll do it in 2 calendar years.
I'll do it in 2 calendar years, just so I only have.
Because you got until April 15th to make a contribution for 2020.
Yep.
And you could do it at any time between now and April 15th, theoretically, for 2021 contribution. But heck, between January 1st and April 15th, it's that window of time when you can make a contribution for the current year as well as the previous year.
Yep.
It's a good time to.
I do mine normally the first 2 weeks in January. And I am married to an accountant, so it does make it easy. She actually, I had it on the calendar. She reminded me.
Yeah, it's one of those things on my list, but it's like, it's.
It is really, I've got to tell you, if it is quite nice being married to an accountant. She pays all the bills and keeps a spreadsheet on our accounts, and it's great. And I love her.
Great.
And I love her. And I got that going for me. And
she's okay. She does such a good job with the bills.
She's all right.
Well, it is interesting, Pat. We'll go back to the calls here in a minute. So if you're on, stick with us. 800-99-WORTH is to get on with Allworth's Money Matters. But
I'm sorry, Scott. 833-99-WORTH.
Whatever I said.
You said 800.
Oh, 833-99-WORTH. They ran out of 800 numbers, I guess. It's interesting in you take care of the investments. I
That's
certainly
right.
hope so because you do for a living.
Yes.
But it's very common in couples where you'll have, and I hate to say it, some of this, still today, when we look at couples retiring today, the majority of the time it is the spouse, the wife who pays the bills, and the husband who manages the investment.
Majority. That's not sexist. That's just what we see. Or maybe it is sexist, but that's just what we see.
In some families, it's the opposite. Some families, it's one person who takes care of it all. But it's oftentimes split up. I think the important thing is that both couples need to have a good understanding of what's going on, at least on a periodic basis. I got with my wife a couple weeks ago and said, here's a listing of everything we've got. Here's where how to access things. Call Pat if I die. Essentially, that's kind of helpful to have.
Yeah, well, it does actually. We trust each other. We actually kind of have a understanding. But I don't know where I was going with this. Consider the Roth contribution, and then conversion. And if you can,
full circle back to the
if you're young, marry an accountant.
Let's find a wealthy one though. If you're gonna look.
My grandmother used to say that to me. She used to say when I was in high school, Patrick, it's just as easy to fall in love with a rich girl as a poor one.
But there's a lot more poor girls at my high school, Mom. My grandma. That's what you should have said, right?
Yeah.
The reality is.
I don't know any rich ones.
Yeah, well, if you had me go to some rich high school, it'd be a little easier.
Yeah, what's wrong with you? Why was this? Why was I born into poverty?
Born in poverty.
Middle class.
Yeah. I think some of a middle class 30 years ago might be considered on the...
Oh, yes. On the upper scale.
Yeah.
Yes.
All right, let's we'll continue on here with calls to be part of Allworth's Money Matters, 833-99-WORTH. We're in Seattle talking with Mark. Mark, you're with Allworth's Money Matters.
Yeah, how are you today? I enjoy listening to your show. I was driving through California last week and picked it up. And but anyway, I was wondering, I'm in my early 60s, and I have a younger sister that's a couple years younger than me who has done zero, retirement planning, and I have tried to urge her, and I've even offered to match to help get her started. What are your thoughts on, how do you move somebody, to understand the value of, doing some financial planning and really budgeting?
How old is she?
She's 60.
Is she not a little worried about the future?
She's never lived, frivolously, but she's not put anything away either. She's lived within her means, but she's not, all she'll have is, her Social Security. And, if I were to die tomorrow, whatever she would inherit from me. But yeah, exactly.
Does she own a home?
No.
So so the question is, how do you get someone that doesn't care to care? Is that what you're asking?
Yeah, she's concerned. And really, this is a bigger question for a lot of Americans,
mm-hmm.
right? As I've watched this whole pandemic thing, and you see all these people that are suddenly broke. How do we help? How do we move these people to think towards the future? And not just my little sister, but and maybe
it is an interesting thing. And I get perplexed sometimes, Mark, because I'm in my mid 50s, and I have a couple friends I can think of that I've known since our kids were like babies, right? And
mm-hmm.
they don't have two nickels to rub together. And I'm thinking,
right.
How do you go through your whole life not saving anything? And then of course, we see the stats like the average American can't go 3 months.
Mm-hmm.
They couldn't pay for a $600 medical expense.
Mm-hmm.
And I understand there's a certain level of poverty where, like, you're trying to figure out where your next meal's coming from. But for most Americans,
mm-hmm.
that's really not where they're at. It's making choices with their dollars.
Mm-hmm.
Because look, as financial advisors, we see it all, right?
Mm-hmm.
We see couples come in who've had very modest incomes,
mm-hmm.
who've got a great retirement savings, and their income
mm-hmm.
needs are actually quite low, so it's a little easier to help at retirement time as well. And then we see others that have
$1 million incomes that come in, and they'll come in and they'll say, "Hey, I've saved up $800,000. I want to retire." And you're like, "Well, you've been living on $1 million, so you can retire for exactly
9 months."
9 months.
Right.
I don't know the answer. I don't know the answer. What I do know is it's a mindset. It's consumerism. I would have them start listening to the Dave Ramsey show, not our show, but the Dave Ramsey show.
Mm-hmm.
And
he does a great job with
the beginners,
Yes.
like this whole mindset about debt and how to save for retirement. He does, and then he has these programs called Baby Steps and Financial Prosperity or Financial Peace University, something like that. That is where I would have them start. And the reason that I like that is because he kind of creates a community around it. He actually has workshops that he does at local churches.
Oh.
Yeah.
And so it's the Dave Ramsey show, where ours is not quite
I'm familiar with him.
Yeah, we're not those guys. I mean, ours is a little bit more technical and a little bit, more people that are further along in the process than Dave Ramsey.
I see.
I can tell you this, though. In talking to a friend of mine who sells Mercedes-Benz for a living, the desire to drive a Mercedes-Benz will oftentimes supersede any common sense, including someone's credit rating, where they work with these people and get them into special financing and higher interest rates because their credit scores are so bad or they barely qualify. And at that point in time, I say to him, well, do you feel bad about selling him a Mercedes? He said he's got to buy it from someone. That's right. They're going to buy it. He goes, should they buy it? No, they shouldn't buy it. But I didn't go to their house. They came to the lot.
Right.
They know the score.
How about later in life when your tax dollars are paying out?
Yeah, right. Where the tax dollars.
Mark, it's an interesting dilemma. We don't. I mean, from school, our childhood school, we don't teach much on basic finances and the power of compound interest and debt.
Right. My two children who are, in their early 20s, when they were younger, I insisted that any money they make, mowing lawns or whatever, and then, of course, into getting, a high school job, I always insisted that they had to save 50%. And my philosophy there was that if I teach them as children to save 50%, when they get older, saving 10 or 15%, which should be okay.
Thank you.
And that's had mixed results, truthfully. Although as they're getting into their late 20s and making a little bit better money, they're doing a better job.
The older I get, the more I'm convinced so much of our behavior we're born with, and when it comes to financial matters, there are people that they're frugal from the get-go, and they love to save, and they are great savers, and they don't care about spending their money on consumer stuff, or they feel better about having the money saved that they still have as opposed to trading it for some sort of experience. And then there's people on the other end of the spectrum that all they want is experiences and stuff. They can care less about saving, right? And it's ideally if you get a couple together and you get one of each, and then you'll end up in retirement with a good amount saved for retirement, but you have some fun along the way.
Right. Well, I think about, I've read about the 1918 pandemic that we went through, and, there was no PPD or there was no unemployment. The government didn't help anybody then. And I see, we seem to keep, relying on the government instead of relying on ourselves. And, I just wonder, how do we, to your point, it's in the schools, because I was going to say about my children, teaching them the saving, they didn't have one class all through school that talked about how to balance a checkbook or how to,
It's not a requirement. My daughter took one her senior year only because she's always looking for the shortcut in life, and she actually works out pretty well for her. And so she took she wanted the easiest math class she had at her senior year. And it was whatever they call it.
Personal finance?
Yeah, it was personal finance or something. And she's like, came home, but like, Dad, this is like, she learned like why you don't want an auto loan and some of those things, but most people aren't.
Oh, that's good.
Well, I appreciate the call.
Yeah, you know what? I mean, with your sister,
Dave Ramsey.
She's going to have to work till 70.
Yeah.
She cannot take Social Security before that. And the challenge is that it's your little sister you love, and you don't want to. And I mean, I'm sure part of it's from you. You're thinking, I don't want to have to be writing her a check each month, right?
Well, I haven't gotten those calls yet,
Well, expect them.
And but to your point, there is a little selfishness of
that's
not
all right.
wanting to get those calls, but also too, I know the feeling of being financially independent, and the confident feeling it gives you to not have to have those kind of concerns, and also being able to if a family member needs some help, knowing that I can do that without harming myself, On the other hand, you want to be careful because you don't want to become an open checkbook.
It's also easy. I mean, we're all guilty of this, where there's certain areas of our life that
Right.
we've got under control. We do well, and it's like,
Right.
how come they don't? But then, if we're honest, there's probably other areas of our lives that we could probably have some improvement upon.
Yeah.
Right.
Oh, sure.
So,
Right.
anyway,
But at least I'll be able to afford to pay for it.
That's right. Appreciate the call, Mark.
All right, thanks.
It's a funny thing is it just doesn't seem that. I remember reading a book years ago, The Richest Man in Babylon, and it just comes down to just save 10%. It was like just save 10%.
Yeah.
Be afraid of debt and save 10%, and everything else is going to take care of itself, pretty much. So
Yes.
All right, we're going to take a quick break. When we come back, we'll continue with some calls. 833-99-WORTH is the number. You're listening to Scott Hansen and Pat McClain, Allworth's Money Matters.
Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
This last week, the Justice Department said they weren't going to pursue charges against Senator Richard Burr. Anyone remember Richard Burr? Here's how quickly things changed, right? So this Richard Burr, GOP Senator Richard Burr, he was accused of making some stock trades ahead of the pandemic.
Oh yeah. He was in the meetings where they were talking about a global crisis, and he was making trades.
But apparently, he said that it was looking at the news. He got it all from Basic News. What was happening in China, and so it said some of his trades spared lawmakers hundreds of thousands of dollars in losses as stocks sank by mid-March.
Well,
but
he would have been better off not making the trades.
My point. That's why I brought this up. That's why I forgot all about this story, because there was a handful of lawmakers, and at the time,
I guess they never got back in.
Well, when do you get back in?
Yeah. Even the insider information, he messed it up. And he works for the government. he's a congressman, right?
I mean, I just thought that I saw that article and I thought kind of funny.
Yeah.
I guarantee he didn't go back in.
Well, we had some close to home. My daughter, first job, has a little bit of money saved. And so she invests in the S&P 500 6 weeks before the decline, right? 6 weeks. I have another son that had some money saved, and he is actually studying for his CFA, Chartered Financial Analyst, pretty smart guy, econ major. And he had taken his money out and told her that she was making a mistake. So he was timing the market. My daughter bought 6 weeks before the market falls. And I asked the approximately same, I go, how did you do this last year, Colleen? And she's telling me. And then I said to myself, well, how'd you do?
the smarty pants econ major?
Yeah. Not nearly as well.
Look, the reality, being an investor is very difficult.
It's emotional. It can be emotional.
It is emotional. And being a successful investor is challenging. Most people, if you look at studies that looks at you look over a long period of time, 20-year time horizon of stock market returns, if you just looked at the S&P 500, the broad market, and then looked how individual investors do
compared
as a
to
whole, they do worse.
Compared to the market.
Compared to the market. Because they tend to move into those assets that have already run up in price and move out of assets the wrong times, right? They buy high and they sell low.
Yes.
And it's not easy riding through a pandemic, a financial crisis like we had a few years back, dot-com bubble that burst.
All of those.
Something's going to happen in the not too distant future, whether that's
But you should not
2
change
months,
your
2
investment.
years, 10 years.
You should not change your investment portfolio unless your situation changes.
Assuming you have the right one going in.
That's right. But I look at my own 401k, right? I've put the maximum I was allowed every step of the way for the last 26 years. My children's friends come to me often and ask me to allocate their 401ks. I show them what I'm doing on the allocation and kind of educate them. This is what. And then I use myself as an example, as I've always just put in the max I was allowed by law, and I've never, ever changed my equity position. It's always been 100% stocks, and this is what it's at now. And the guy's like, you're kidding me. And I'm like, no. And it's not any special genius. It's just consistency.
And you put the maximum in.
And the maximum from day one. First time I ever got a job that I had a 401k, first paycheck that I was eligible, put it in. Because I figured, look, I've lived without that money anyway.
What's the maximum this year? 19 grand a year for someone
well,
under age 50?
And then there's a catch up of another 6,000 or something like that. So I think it's 25 grand, 26 grand.
If you're over age 50.
Correct.
Or 50 or older. But if you're young, getting in your 20s, 30s, let's say you're 5 years out of college, there's no reason you can't be putting in the maximum in your 401k.
Yes, especially if you're used to not making any money to begin with. It's all new money to you. So,
it's letting the markets run their course. But when every day, when I get up, I glance at the markets. Obviously, one of the first things I do in the morning. Mm-hmm. You looked at me weird. Do you not look at the markets in the morning?
Yeah, I look at the markets.
I'm like, good for you. That is a good discipline. I don't look at the markets till 8 a.m. That'd be a great discipline.
You're just like, I mean, we go without saying that you look at the markets every day, wouldn't you? Oh, it's not going to change behavior. Why do you?
I don't know.
We kind of have to.
Well, it's part of our job. But I honestly hope for down days. Because the more we go with an up 150 points or percentage-wise, NASDAQ up another percent, up another 1.5%, up 0.5%. Oh, down 0.25%, up 1.5%. It's like,
how long? Bigger the bubble. But listen, I thought you talked to me at the beginning of the pandemic, I would have never been able to predict where the markets would be by the end of the year. I certainly wouldn't have predicted they were up as high as they were.
And you don't invest your own dollars nor your clients' dollars based on what you might predict or what you feel the markets are going to do.
That is correct. That is correct. That is a fool's errand. Because over the long term, what drives the equity values of stocks is the underlying earnings of the companies. Over the long term. Over the short term, what drives values of stock is
anyone's guess.
Investor sentiment.
We could say the Fed's pumping all kinds of things.
We could say anything after the fact.
It's when the future good news isn't quite as bright as today's good news. That's when things can start to turn.
Even before it actually shows up in the economy.
Yeah, when the future's good news isn't quite as good as today's good news.
That's right.
The belief of the future's good news isn't going to be as...
Whether good news, fake news, real news, whatever.
Yeah, but it is...
Stay invested.
Yeah, for your long-term dollars, stay invested and be diversified of those dollars that you need for your retirement. If you don't, then go ahead and keep investing in whatever you feel like. But all right, let's talk with Maria. Maria, you're with Allworth's Money Matters.
Hello, Scott. Hello, Pat. Thank you for taking my call.
Yeah, glad you joined us.
I really appreciate it. Yes, I spoke with you about a year ago when I had a question regarding financing my daughter's education. she was going to medical school in the fall, and I wanted to help her financially as much as I could. So I was considering refinancing my mortgage and taking some cash out to cover some of the expenses. I'm not sure if you remember.
And out of curiosity, tell us what our advice was. I'm interested.
We probably said let her figure it out as much as possible, I guess.
You said to load up on student loans.
Okay.
And because if I was to take cash out, then it will be my responsibility for the rest of the loan. So the life of the loan. So
That's right.
So the fall semester came and she took out $50,000 in student loans. But the semester was online, and she ended up living at home, and some of the fees were not applicable. So she ended up not needing $17,000 of the $50,000.
Okay.
And she had the option to return whatever she didn't need by the end of the semester, and the loan amount and the loan origination fees and everything would have been adjusted.
Okay.
And so we were faced with a difficult decision what to do. Do we return anything at all? Do we return the $17,000 that she didn't need? Or even return $37,000 because she had $20,000 saved from a job she had while she was in college. What we did, we ended up paying back $17,000, but I'm not sure if that was the right decision, and I wanted to get your perspective on this, especially that we are facing the same question this semester. She took out $50,000 again, and she will have some left over. Do we keep what she doesn't need, because eventually she will need it when she moves into rotations and she has to cover a lot more? I don't know. Or she can take new loans then.
Here's I guarantee one of the reasons we said to use the student loans is because the potential for forgiveness. There's already forgiveness in the books now. That if someone could work in the private sector, the amount they have to pay is limited to a percentage of. They make up this income formula. It's
based on the higher your income, the higher the percentage of your income needs to go to the student loans. The lower your income, the lower the percentage.
Or nothing goes to
or nothing at all. And then after 20 years,
it's forgiven.
It's deferred. It's forgiven. What type of medicine is she studying, Maria?
She's just starting medical school, like human, like not veterinary, and she will choose her specialty towards the end, I guess.
Okay. And the reason I asked that is because, so I was talking to a friend of mine, daughter, same situation. There's a rural community program that actually forgives all student loans if you become a doctor in rural communities. I think I would, quite frankly, I'd probably load up on the student loans.
Didn't you take a student loan in college and invest in stocks or something, Pat?
I might have. Yes, I did. I did okay. I don't think that was what the student loan was designed for.
No, I don't think so. I mean, that's the definition of moral hazard, right? Like, if it were me, if it were my daughter, I would probably go the route you're going. Like, let's don't take more student loans than we need.
But the question is that, so when she goes on rotation or does her residency.
I mean, I don't want to try to scam the government or anything.
Understand.
Our job as advisors is to help people navigate through the tax code.
But she has $20,000 in the bank already. And so this year, we're talking about $34,000 in debt.
What's the interest they charge while she's in school?
Well, right now it was 0% that past semester, and I think it will be 0 until the end of January unless Joe Biden extends it. But the loan.
What do you think is going to happen? He's already.
And what's the origination cost on the amount?
It's 4%. It's 4% of the amount, and that's why we.
I'd pay it back. I'd pay it back. That cost of money is high.
They already paid it back. The question is, this next time
semester,
around, she take out as much as she needs.
Yeah, take out the $50,000 and pay back the $17,000 at the end of the
or whatever she doesn't
whatever
spend.
you don't spend at the end of the semester. So take as much as they'll lend you today, and then at the end of the semester, they give you the option of actually paying it back, the monies you did not use, including the origination fee. Then you would pay it back then. I wouldn't borrow less. I'd borrow the same amount with the plan of paying it back because
Even though she has
anything could
20
happen.
grand of her own money to spend.
Even if
something.
that 20
That's not
grand.
a lot of money, by the way.
Yeah, that 20 grand, I wouldn't use any of that to pay back the loans. I'd keep that in reserve. When she goes to do her residency or rotations, whatever, wherever it may be, she may need to use some of that.
Right, and that was our thought too. I'm like, we don't want to go down to zero, and if we need.
If I were a betting person, I would bet there's going to be some forgiveness of her.
That would be
loans going into medicine.
Yeah, that would be.
There's going to be a shortage of doctors.
Should we keep the 17,000 this semester, or should we just keep returning what she doesn't need?
If it were me, I wouldn't take out more student loans than I actually needed for my education.
Yeah, I would return the 17,000.
Yeah. Mm-hmm. Okay.
All right, because it's a 4%. The cost of money there is 4%. That's high. That's high.
Yes.
Yeah. Right. So
it sounds funny.
It is.
There was a time at 4%. That's like almost free.
Yeah. So return that 17,000. Borrow another $50,000 for this semester, and then at the end of the semester, return any unused dollars. All righty.
Okay. Yes, and I have another question.
Sure.
Because when they gave the second 50,000 this semester, they dated it back to August, and we're like, why is it going back to August? Because these are two separate disbursements. And so they explained to her that this is the cycle. It's one loan, but it's dispersed twice. Something. Do you know anything about this?
I haven't a clue, but it sounds right to me. Basically, what they're looking at
They did
is
the underwriting once.
it's their year. It's their calendar. The calendar says that it starts at the beginning of the semester and ends at the beginning of the semester, so it wouldn't bother me.
So if the interest rate was like 4%, we would be paying 4% on the second 50,000.
No, because it's simple
August.
interest. So you would only be charged, assuming you were charged that interest during that time. You would only be charged the interest of any outstanding balance you had during that period.
Not from the date of the loan, only the date of the distribution to the recipient of the loan.
Really? Even though, okay.
All righty.
It's dated. Okay, yes.
All right.
Thank you so much.
Thank you, Maria.
Appreciate the call.
And if I were a betting man, I would bet in the next 4 years there's going to be some forgiveness of some student loans.
Oh, I wouldn't be in a hurry to pay down the student loans.
I mean, how much did we go into debt? Another $3 trillion last year. We just had another package of almost $1 trillion. Biden's already talking about another $1.9 trillion. It's like it's candy.
You
it's
start
like it's free
throwing
money.
trillions around, and pretty soon it's going to add up to real money.
What's another $1.5 trillion for getting rid of some student loans?
By the way, what we are starting to see is consolidation in the college space, which is long overdue, where colleges are actually being purchased by other colleges and colleges closing down. You're thinking, how could that be good? Well, it's the marketplace. The marketplace is actually adjusting to the supply of the students.
I was talking to a
demand.
friend who was on a board of trustee for a small university. And I said, because they were talking about, they were looking at raising some money for this or that. I said, at what point is it not better for you to merge into another university and be a remote campus? He's like, well, what do you mean? I'm like,
Yeah.
How many boards of trustees are typically free? They're not paid jobs,
But the administration
all
isn't.
the administration, figuring. I mean, you think of
all the
that goes into it.
benefits, software,
All that goes into it. Like,
teacher selection, HR.
like, why do we need a bunch of little campuses with 2,000 people?
Yeah.
Well, we're already starting to see it.
We're starting to see it.
The market's doing it.
And the reality is, over the last 20 years, the higher education has been the true cost has been subsidized by the federal government and student loan programs.
No question.
It has driven the cost of education higher, not lower, higher. Why? Because there's more capital that's chasing it.
I certainly don't begrudge any professors, but a lot of them have really nice schedules.
Yeah.
Right? They have a couple classes. They have the grad students teach the classes. I mean, they're not working 40 hours a week. I'm not blaming them.
No.
But I don't think that'd be the case if there was a limited amount of dollars to go towards
Resources?
education. But it's almost unlimited when the government issues student loans to anyone who can fog a mirror.
Yes, and almost any type of education.
Doesn't matter. Ancient history, basket weaving, perfect. We'll get you signed.
I don't know how many of those.
I bet there is something. Like that.
Why no?
I'm sorry. It would be
let's go.
I won't even go.
All right, if you'd like to join the show.
What a current. I couldn't imagine
Scott.
looking through a college curriculum today and just even the titles of some of the classes.
833-999-6784 if you'd like to join.
All right.
I'm trying to change the subject before we get ourselves in trouble. 833-99-WORTH.
All right, let's talk to Illinois. Go to Illinois, talk with Len. Len, you're with Allworth Money Matters.
Yes, gentlemen. Thank you for taking my call. You're scaring me with this trillions in debt stuff, but
I'm not making it up. Yeah, we see it all.
I'm 66 years old, about to retire. I have a 457 plan, and I also have a regular IRA from another former employer. And I would like to consolidate them and kind of wondering what should I consider in which one to roll my money into.
Where's your IRA today?
It is with Vanguard.
Are you confident in your ability to both select investments as well as manage this throughout
I
your
don't
retirement?
know that I am. I would probably go with just a date-targeted plan. I don't know, like a 2030 or something, and just let them.
And how much
deal
is
with
in
it.
your 457?
I don't really need the money to live on. My 457's got about 180,000 in it.
And how about your IRA?
The IRA's only got like 30,000 in it.
And you've got a pension coming in, so you don't need these dollars for retirement income.
Correct.
And you're 66, so at age 72, you're going to have to start taking required minimum distributions unless it gets pushed out a couple more years.
And how much will
which is
your
possible.
pension be?
It will be about 38,000 a year.
And will you be eligible for Social Security as well?
I will be.
And I assume you have no debt.
No debt.
Okay. So I would consolidate the dollars out of the 457 and into the IRA. So I assume that you either work for a state or a municipality.
Yes.
Okay. And so what happens is technically, and you're in the state of Illinois, so technically that 457 is an asset of that municipality. Now, I say technically, there's only been one instance that I'm aware of where they've actually, if the municipality.
But Illinois, their finances are in such good
Well, that's
shape.
why I said you live in the state of Illinois. Because
We're in California, so we're
we can pick on
cousins here.
we can actually pick on guys like New Jersey and Illinois, but no one else. So I would move it over to the Vanguard fund, and I wouldn't use a target date. I actually wouldn't. I would probably get a little bit more aggressive with this, and I would actually probably go, depending upon
You could be much more aggressive in this,
much more aggressive. I would go
depending on your comfort zone, because your time horizon is very long. You just said you don't need the dollars.
Yes.
Yeah, and so I would probably go 70 to 80% equities.
Are you married?
I am.
And how old's your spouse?
She's 63.
What do you think these dollars will be used for?
I don't know. I guess we're so blessed. We haven't given it a whole ton of thought.
So I would go 70 to 80% equities in this, and the rest some cash, bonds. And
Well,
maybe
you could
some,
certainly do that because you can consider the rest of your income as fixed income
is
secure.
bond. Yeah. And then what I would do is I'd go through the calculation every year between now, the date of your retirement, and age 72, and look to see whether you should do Roth conversions on that. And part of that driver will be your marginal tax rate versus the people that you name as the primary beneficiary on your IRA's marginal tax rate. If they're the same or yours is higher, you may not actually want to convert. But that's what I would look at. And I wouldn't use a target date on this.
No.
In fact,
Okay.
I would actually pay someone to actually allocate it for you.
Yep. And well, of course you would believe that. That's what you do for a living.
Well, we typically manage someone's whole portfolios, and we can do it on a one-off on an hourly basis or by a project, or
Yeah.
we manage the monies.
You get a good advisor. Studies have shown that a good financial advisor, and we're not trying to pitch in our services because there's lots of good advisors, but a good financial advisor will earn much more than what you pay for in a typical fee.
Well, and part of that is the Roth conversion, which you didn't ask about at all. which is what I would actually concentrate. If you were sitting in
It's all the financial planning aspects that go
Around
along with
it.
plus the behavioral finance.
But you can most certainly, that's why I wouldn't use a target date. You need to be more aggressive than what a target date would allow you to do. And I would go 70 to 80% equities and not worry about it. And if you want to pay pay someone to manage it.
Well,
Don't let them sell you an index annuity or any of this garbage. You just
Let me ask you this question. What percentage of your portfolio is in stocks today?
A fairly high percent. We have, we're heavy in real estate, personal real estate. We have a second home, and we have an E-Trade account with about 130,000 in it. Percentage-wise, between the IRA and all of that combined, we have we're probably at about 70%.
Right. Well, to Pat's, then don't change that.
Don't change it. I just would put everything in an IRA, and I'd actually move the money from E-Trade. I'd get it all at the same custodian, just so it makes your life easier. There's no reason to have some money at E-Trade and some money at Vanguard. You know,
one or the other.
It's I don't go to one store for milk and the other store for eggs.
Your wife probably does. My wife goes to Trader Joe's.
That's where my wife
Rayleigh's
goes.
and Nugget. There it is. Those three. 3 stores. And Target sometimes for some. And Costco. 5.
Yeah.
Okay. All right. But thank you. So what was your question?
Vanguard may charge less of a fee than the 457 I'm with.
Oh, look, the difference. It's pennies. If it's anything at all, it's pennies, and they might charge a little bit more on something and less on something else. But the 457 and the Vanguard internal cost.
What would if fees are almost nothing at Vanguard? But the question is not really the asset management fee as much as the overall financial planning and investment advice fee around this, where if you had an advisor kind of overseeing the entire thing, looking at the real estate, looking at the E-Trade, when do we do some Roth conversion? Do we have to? Are there some things to consider about taxation when it comes to real estate? When do you start Social Security? When does your spouse start Social Security? All of those things. And I mean, I understand Vanguard has like a call center with a bunch of certified financial planners. I don't know if I can't vouch for whether they do a great job or not. I don't know enough about them. I like Vanguard for their index funds. We use them quite a bit at Allworth, but we don't use their. I have no idea how their financial.
Anyway, appreciate the call. Congratulations on the retirement.
Thank you so much.
Yeah, congrats on retirement. It's always that day kind of slips up, I think, quicker than a lot of people.
Yeah, people keep asking me when I'm going to retire.
Well, I've been asking that for a while. Okay. When are you retiring?
Okay. So we have upcoming virtual New Year's retirement workshops Tuesday, January 26th, 27th, and 28th. And you can find those at allworthfinancial.com.
Yeah. And they're good. I mean, that's the world we're in right now. So we're not having live events, but they're good. I mean, they're really good quality programs. New Year retirement workshop. Again, January 26th, 27th, 28th. We're out of time. It's been great being with you. You've been listening to Allworth Financial's Money Matters. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.